My
Would you prefer to receive the explanation in French or in English?
In English.
In English, all right. So it's given 20 minutes to present its case to the judges. I will hold up a sign for the last 10, 5, and 2 minutes, as well as for the last 30 seconds of the presentation. During the last 10 seconds, I will indicate with my fingers the number of seconds remaining. If you have not finished your presentation after 20 minutes, you will be stopped in order to proceed with the Q&A period. A Q&A period of a maximum of 5 minutes is allocated to the jury at the end of your presentation. Please note that at any time you cannot say or refer the name or the location of your university.
Hello, Mr. Fontenelle. During the last several meetings, you've been talking to us about several different issues that you've been having and how we can resolve these issues in order for you to get out of these situations with the less tax implications as possible. Let me first introduce to you my colleagues. On my right, we have Christina and Max and myself, Aaron. So, as you can see, you are married to Natalie for several years and you have 3 different children. One of them following in your footsteps, going into pharmacy, and might even become a doctor, and might become just as well known as you as a pharmacist. You also have a sister who owns her own design company, and you have lent her money in order for that business to start off, and in order for her to start becoming her own person and be able to do business on her own. As time went on, she has stated to you that she does want you out of the business and that she does want to pursue her own dreams by herself. So that is one of the main issues you have. And you also own a management company that does a lot of investments in real estate. So for the several issues that we have, the first one being that you have to dispose of the shares in the design company that you own. The second is you are willing to purchase a franchise in your life. And your third option is that your management company is having several different issues with the assets that are being converted into another company in order to minimize the litigations in the law perspective. You also have several different personal issues that we will go over in the presentation. I will now pass it to Christina, who will talk about the sale of design.
Alrighty, so your sister has said that she wants to purchase your shares of the business. Now we are proposing that there are 3 different options in order to proceed with the sale of your shares. The first option is you can have the shares redeemed by the company, and therefore she will have 100% control of the company, allowing her to be independent. The second option would be you would just sell the shares directly to your sister. She will purchase them in totality, or you can sell them to her, issue her a loan, and she will pay them on over 5 years in order to realize the sale. Now we'll just go over the 3 alternatives and see the advantages and disadvantages. So first thing to consider is that we need to see if your sister's business is a qualified small business corporation. Because if it is, you would be allowed to use your lifetime capital gains deduction on the sale of the business. So the 3 criteria in order for it to be a small business deduction is the first, on the date of the sale, 90% of the fair market value of the assets must be used in active business. The second is in the last 24 months, it must be owned by the shareholder, which is yourself, so that criteria is met. And the third one is over the last 24 months, 50% of the assets must have been used in the active business. So we don't have information as to whether or not the first criteria is met, so we'll proceed with the alternatives, assuming whether or not they're met. So option number 1 for the redemption of the shares. We will take the proceeds of redemption, which is $10,000, minus the PUC, which is $500, would give us a deemed dividend of $9,500. This deemed dividend would be grossed up, and you would also have a dividend tax credit. However, the deemed dividend is subtracted from the proceeds of disposition, so therefore there is no capital gain on this option. And the second option, we'll sell the shares to her directly. And the proceeds of disposition would be $10,000, which is the fair market value. And with this option, since it is realized all at once, then the lifetime capital gains deduction could potentially be used if the criteria is met. But we would need to consider, does your sister actually have the funds to purchase the shares? So which is why we're going to go to the third option, where you would issue a loan to your sister in order for her to acquire the shares. And then she would pay you back on a 5-year basis. So we've also noticed that in your management company, you do have a CDA balance. So that is money that you could take out tax-free. And so this is where you would get the funds in order to make the loan to your sister so that she could purchase your shares. So in this situation, if she pays you back over 5 years, automatically the capital gain would be realized over 5 years. However, you could elect out of that and realize the capital gain all at once. You would only do that, of course, if you are eligible for the lifetime capital gains deduction. So moving on, we also noticed that the assessment for the CRA said that you have business income for the sale of your investment property. Now, we are recommending that we actually go ahead and contest and repeal that decision, because looking at your personal balance sheet, it does not seem that you are in the business of buying and selling investment properties. What the CRA looks for in order for it to be investment property, to be business income, is that you buy and sell it on a regular basis and you have the intention to make business profit. So in this situation, you also had a capital gain of $125,000. So it's unlikely that you bought and sold it in a short period of time to realize that capital gain. So we are concluding that this should actually be a capital gain and not business income. So you should go ahead and repeal this decision. Now, the third thing that we need to also address is you made a loan to one of your friends and her business is actually going bankrupt. So this $25,000 actually is an allowable business investment loss. So what that is exactly is, since her company is not succeeding, this loss that you have for the $25,000, since she cannot pay you back, would actually become an allowable business investment loss, of which 50% would be deductible. In the first 10 years, it could be used against any type of income, and then after the 10 years, it converts into a capital gain, so that you can use it only against, it converts into a capital loss, so that you can use it against capital gains. And third thing, there is the advice that your lawyer gave you. You do have a management company right now, which does have an investment property in it, as well as other assets. Now, the lawyer recommended to you that you actually go ahead and roll over this asset into another corporation in order to protect the other assets that you have. Now, we're proposing that this would actually be a good thing to do for you. So what we're actually proposing is that you would need to incorporate a new company and roll over the capital assets only into this new company. And the reason you would do that is, for the first, take the advice from the lawyer in order to protect your other assets, which is the investments. And by transferring over the capital assets, which are the income-producing assets, you are rolling over the active assets. So in the future, if ever you were to go ahead and sell the business, you would most likely meet the purification test in order to have the 90% of assets used in active business. So upon the transfer of the rollover, after you incorporate the business, you would need to file a joint election with the corporation, and you would roll over the assets. So the 3 assets that would need to be rolled over would be the land, the equipment, and the real estate. Now, also noting that for the equipment, we would roll it over at the fair market value, since it is at a loss. And the reason we would do this is because your business would need the asset, and that's why we need to roll it over. Usually, assets with a loss will not be rolled over, but since your business would actually need it, we would go ahead and still roll it over. So what this would do essentially is your business would have all the active assets. So the tax value of your shares that you take back upon the rollover would be ECB at 0 and a PUC at 0. And now I'll pass it to Max for the franchise.
So looking at your franchise option right now, it's going to be basically starting a new business for yourself. Now, starting a new business is definitely a big step in your life, and we really have to set it up properly from the beginning to make sure that everything in the future could be properly planned for estate planning purposes. Now, that being said, really what we want to do is structure the acquisition of the franchise in a way that you can benefit both now in the present as well as in the future. Also, really what we have to do is we have to look at your family situation to see how can we structure this so that maybe we can even benefit from your wife or your kids in other kinds of in other tax ways. Now, there's really two different alternatives that we can do when it comes to buying this franchise. Alternative number one would be purchasing the franchise personally. Now, purchasing the franchise personally, really what that would do is it would create a sole proprietorship for you. Now, that being said, really it would be less costly to start up because you wouldn't have to incorporate a new business. But also, this would qualify as business income, which you could write off things against the income at that point. Now, that being said, there are several disadvantages to not incorporating just buying the franchise on its own. Now, some of these disadvantages would be definitely you wouldn't be able to pay any dividends through the business itself. All the income would get taxed at once. So regardless of how much of the money you need to use in the year, the entire business will get taxed at a personal rate and not a corporate rate, which personal rates are much higher than the corporate rate. Also, for estate planning purposes, we're going to be somewhat limited because, that being said, once you're looking into estate planning, if it's a sole proprietorship, it'll be harder to maneuver when it comes to selling shares of the business or anything because there are none right now at this point in time. Now, also, when you're trying to sell a business and it's a sole proprietorship, you're actually not eligible for the lifetime capital gains exemption because it isn't a CCPC at that point. Now, looking at alternative two, you could definitely purchase the franchise with a new corporation. Now, really what we would have to do is we'd have to set up a new corporation for the franchise, and the business itself would purchase the franchise agreement of $250,000. Now, this $250,000 would actually be a CEC, and 75% of the cost would be added to the CEC balance, and then 7% could be taken every year to reduce your income. Now, another big advantage to the business would definitely be that it would be eligible for the SBD. Now, what the SBD is, it's basically a deduction for active business income for a corporation that'll help you save tax dollars in the future for sure. And really what it is, it's 17% of the lesser of ABI, the 500K limit, or the certain foreign tax credits. Now, that being said, right now you have you make $150,000 a year. We project that a pharmacy should be making more money than that. So having the option to defer the income and defer the taxes on that income would definitely be beneficial to you. A disadvantage obviously will be to setting up the corporation and some of the legal fees, but in the long run we feel that this will have very little impact as to how much you'll be able to save using this type of option. Now, another thing that we've also looked into is both you and your wife haven't used your lifetime capital gains exemption. Now, that being said, when we're setting up this corporation, something that we could look forward to in the future is setting up the business that both you and your wife could hold a percentage of the business. Now, by issuing shares to both you and your wife, at a later date when you'd like to sell the business, it would allow you to use the lifetime capital gains exemption for both of you, which would definitely be much more beneficial because it would be $1.5 million instead of you just having $750K. Now, some of the tax implications of the franchise that we've looked to was the CEC, but also in the contract, we know that there's going to also be a rent expense from the franchisor, and also we know that there's going to be a marketing expense of $1,000 a month. Now, both of these expenses will be used to reduce your active business income, which will obviously help you in the sense that you're going to have to pay less tax on those on your active business income itself. Now, if we look at it, the new structure would really end up being that you would have 100% of the new corp property that Christina spoke to you about. You'd have 100% of Gestion Fontel, which was your management company, and then you and your wife would each have 50% of the shares of Eurolife. Now, I want to give it to Aaron, who's going to test you some of the different tax implications, both for you personally, for you and your family.
So, as you mentioned to us during the meetings, is you do have an income on a yearly basis for the last 3 years of about $150,000. You have an RSP contribution room of $22,000, and we are stating that you should contribute the maximum amount in order to minimize your net income, in order to minimize the taxes payable that you will have during the year. You also have a shareholder loan, which is under section 15.2, is because you receive a loan and you are the only shareholder in that company and you have been incapable of paying that loan within the next taxation year, you do have to add it into your net income. So the amount that's left to pay is $24,750, which is added into your net income. You also have an allowance for your car. Because you use your car on a daily basis to commute to work, your employer gives you 55 cents per kilometer that you drive. As we know, that is a bit excessive, so the amount that is excessive, we took an estimation of the kilometers used per month of about 1,667, and we multiplied it by the excess amount, which gave $50. And you have an active business loss of $12,500 because of the company, your friend's company going bankrupt. The total income comes to $140,300, and we took a tax rate of about 45%. You also have several different credits that you can take in order to minimize your taxes. You have your personal, you have your spousal, you have your tuitions that you're paying for your son, and as long as he's not making income, you can take, he can roll over his credits in order for you to take them. You also have a child amount, and you have others, which comes up to a total credit of $4,023, and your total taxes payable are $59,112. The next option is if you decide to go into the franchise, because you live so far away, you would have to move. And because the commute is long, the new franchisor has given you the option to give you a relocation loan. In order to do that, you would have to sell your primary residence. That's 100 kilometers away. Once you sell your primary residence, you would have a capital gain of about $100,000. But you can take the primary residence deduction, which is 1 plus the number of years you lived in over the total amount of years, times the gain, which gives you $100,000 of tax-free deduction in order not to pay that taxable capital gain. And the second thing is the reallocation loan. Because you are moving 40 kilometers closer to where you would be opening the franchise, you're allowed to receive this reallocation loan. Once you receive this reallocation loan, the first $25,000 of the loan is on a tax-free basis. The next option you also have is that in the next few years, you're going to have a lot of expenses in order to send your kids to school, about $200,000 you estimate. In order to do that, you can start off an RESP account, and what that does is that you can start saving money for your kids' education, post-secondary and university. What that does is that you put money from now, because you have about 14 years until your last son graduates university, if all goes well, or a bit more time from there. In order to do that, you contribute about $12,000 a year, and the government also helps you by contributing themselves by about 20 to 40% of what you're contributing. All this does is, when you put the income in, it's already taxed. Once the money comes out as withdrawals, the person removing the money, so your children in this point, will be taxed on the benefit that you've received in that account. You also have another option is once you purchase the franchise from a corporation, you can also hire your son as a pharmacist or a pharmaceutical assistant. What this does is, because he wants to become a pharmacist like you, the company can then pay for his education. Because he is doing the type of education that is best suited to increase his knowledge within the corporation in order to move on, the corporation can take that as an expense, and your son himself can use that as a tax-free benefit because it's not gaining on his personal knowledge, but he's actually helping the corporation in order for them to move on and increase their possibility of growth. So to conclude, you have purchased shares of your sister, and you will be selling them in order to minimize the taxes, in order for her to let go and she can grow by herself from there. You've also purchased the franchise from a company in order to minimize the tax implication, and you have several different tax issues and future savings that you have to start thinking about in order to maximize all of your possibilities from today in order to have the best future possible. I'd like to thank you, and I open the floor to any questions.
I only have one question with regard to the, I just don't know what you call it, A-bill. So is there any criteria to take those kinds of loss in the fiscal year? I don't know, in the tax return?
Well, the criteria is that it must be a qualified small business corporation.
Okay. And do we have to do something in our tax return to take this deduction, or is there just, I just don't know how it works. Can you just explain a bit what is an A-bill exactly?
Okay, so what happens is, because you've invested into a CCPC, which is a QSBC, is that $25,000 that you have invested, you're allowed to use it as a loss if the company is going bankrupt or you're going to lose that money that you've invested. What that happens is, in the year that it happens, you're allowed to use it against any other type of income. After that, you can carry it forward if you were unable to use it, but you can only use it against capital losses for about 10 years. And for the first year, you can only take 50% of the following amount.
Okay, I have one too. Have you considered the use of trust for my kids in the new ownership of the company? And if so, what will be the advantage?
Well, if we were to look into a trust, it would be more to be able to distribute the income through the trust to your children. Right now, really what we want to do is have the corporation own the franchise, and if it would be at a future time, we could issue shares to a trust that would allow us to then pay dividends through the trust to the children. Also, we can make the children shareholders if we wanted to pay them dividends. But really what we have to be careful about is two of the children right now are under 18 and they'd be subject to the kiddie tax, so really it wouldn't be right now to do it.
That's pretty much it. Thank you very much.
Thank you.
Thank you.
Do we post this? Okay, thanks.